There is more cash sitting inside one company right now than the entire GDP of countries like Portugal or Greece. We're talking about nearly $400 billion. Sitting idle, earning interest, but not working the way Warren Buffett's money usually works. For decades, the rule was simple: Buffett finds value, Buffett buys. But right now, the cash pile at Berkshire Hathaway is the largest it has ever been in the company's 60-year history. And the man making the call isn't even Buffett anymore. So today we're asking the question every value investor wants answered: what actually happens when this money finally moves? And more importantly, what does it mean for you, the retail investor watching from Mumbai, Delhi, or Bangalore, with your own SIP running quietly in the background? Let's rewind. Berkshire ended 2025 with roughly $373 billion in cash and equivalents. That figure reflected Warren Buffett's increasingly cautious stance toward markets he had repeatedly described as expensive. Instead of chasing deals at inflated prices, Berkshire let the pile grow, parking the bulk of it in short-term treasury bills. Then came the transition. On January 1, 2026, Greg Abel officially stepped into the CEO role Buffett had held for nearly 6 decades. And in Abel's very first quarter at the helm, the cash pile didn't shrink. It grew. It rose to more than $397 billion in the first quarter, up from $373 billion at the end of 2025. That's not a typo. The new CEO inherited the most conservative balance sheet in company history, and in his first 90 days, made it even bigger. Here's the uncomfortable truth for anyone hoping for a big splashy acquisition: Abel didn't grow the cash pile by buying nothing. He grew it by actively selling. Abel net sold $8.1 billion of equity holdings during the quarter, including positions that had previously been managed by Deputy Todd Combs. That's an active decision to reduce exposure, not just inertia. And at the annual shareholder meeting in May, when CNBC's Becky Quick pushed Buffett directly on this, he told her plainly that he did not see the ideal investing environment right now. Buffett has said it before in shareholder letters: finding what he calls elephant-sized acquisitions at sensible prices has become genuinely difficult in a market where valuations look stretched. This isn't fear. This is discipline. The same discipline that let Buffett sit out the dot-com bubble in 1999, while everyone called him outdated, right before the crash proved him right. But here's where it gets interesting. The cash isn't completely frozen. There was a signal in March 2026 that the market almost missed. Abel approved Berkshire's first share buyback in 21 months, roughly $234 million. In dollar terms, against a $397 billion cash pile, that number is tiny. But symbolically, it was the first capital return decision made entirely under the new CEO. Think about what that tells us. Abel isn't paralyzed. He's not simply continuing Buffett's caution out of habit. He made a deliberate, calculated first move, small, controlled, almost like dipping a toe in the water before deciding whether to dive in. At the annual meeting itself, Abel was direct about Berkshire's flexibility. He described the company's ability to shift capital from insurance into equities, into new businesses, or simply hold it in cash, whatever the moment calls for, on Berkshire's own terms, not the market's. So let's actually answer the question in our title. When, not if, but when, this money moves, what does it look like? There are really 3 paths. Scenario 1, the elephant-sized acquisition. This is the dream scenario for Berkshire watchers, a company so large that only Berkshire's balance sheet can absorb it. Think energy infrastructure, insurance consolidation, or a major industrial name trading below its true value during a downturn. This requires a crash, a panic, or a forced seller. Buffett's playbook has always been, be greedy when others are fearful. Scenario 2, accelerated buybacks. If no elephant appears, returning capital to shareholders through repurchases is the next best use of cash. The March buyback may have been the opening chapter, not the whole story. Scenario 3, a measured equity build-up. Rather than one giant bet, Abel could quietly accumulate positions in quality businesses over several quarters. The way Buffett built up Apple, methodically, not all at once. The honest answer? It's probably some combination of all three, deployed gradually rather than in one dramatic announcement. Now here's why this matters if you're investing through a SIP in Nifty or Sensex stocks rather than Wall Street. Berkshire's behavior right now is a masterclass in something most retail investors in India struggle with: the discomfort of doing nothing. When your SIP statement shows cash sitting uninvested, or when the market feels too expensive to add more, the instinct is to feel like you're falling behind. Berkshire, with professional analysts, unlimited research budgets, and 60 years of track record, is telling you the same thing patience always tells you. Valuation discipline beats activity. The lesson isn't hold cash forever. The lesson is, don't deploy capital just because you feel pressure to do something. Whether that's chasing a hot midcap because your WhatsApp group is talking about it, or trying to time the next Nifty dip, Berkshire's $397 billion says the smartest money in the world is comfortable waiting too. But let's not pretend this cash pile is purely a strength. There's a real risk brewing here, and it's worth being honest about it. Berkshire's operating earnings in the most recent quarter, while up on some fronts, came in below analyst expectations, and the broader profit figures showed real softness in parts of the business, including a notable drop in Geico's underwriting earnings. A cash pile that large sitting idle for too long starts to look less like discipline and more like an opportunity cost. Shareholders eventually ask, if you're not finding anything to buy, why not return more of it to us? This is also Abel's real test. Buffett could sit on cash for years because his track record bought him patience from shareholders. Abel doesn't have 60 years of credibility yet, he has 1 quarter. The pressure to prove he can deploy capital, not just preserve it, will only grow. So what happens when Berkshire finally deploys its $400 billion? Probably not a single headline-grabbing moment. More likely a slow unlock, a buyback here, a position built there, and eventually, if the market gives him a real crisis to work with, one big swing that we'll all recognize as the moment. Until then, the lesson for every value investor watching, whether you're managing $400 billion or a 5,000 rupee monthly SIP, stays exactly the same. Cash isn't laziness. Cash is optionality. And the investors who panic into bad decisions almost always wish they'd just waited. If you found this breakdown valuable, hit subscribe. We cover Buffett, Munger, and what their principles mean for Indian retail investors every single week. Drop a comment. Do you think Abel makes a big move this year, or does the cash pile keep growing? Let's discuss below.